So, year-end tax planning. It's a right time for us to discuss, and planning and time taking over here right now will keep you good for the rest of the tax season. I'll be taking the individual side of the tax strategies, but we have identified 10 strategies that are useful for the most of us. The first one is standard deduction. As you all know, that standard deduction is fixed dollar amount that can be claimed as a deduction from your tax returns. For 2025, with introduction of One Big Beautiful Bill Act, this limit has been increased up to 31,500 for joint filers and 15,750 for single filers. It's a good news. The better news is at this limits are indexed for inflation, meaning this will vary year over year as the living costs increase. High income earners like you will still need to itemize. So if you are itemizing, consider bunching your itemization into a single year and deferring the standard deduction claim to the next year so that you can make the most benefit out of it.
So one example, you can take property taxes are claimed in the year they are paid. Let's say if the property taxes are very high in New Jersey. So if you are paying property taxes 20,000, you pay in next year's property tax in December. So you have the right to claim it in the year you are paying, not in the year that is meant for, but in the year that you are paying, you can claim the property tax in that year. So in the year where you intend to itemize, try to bunch up the expenses, try to inflate the expenses. Next year you can claim standard deduction anyway.
So next one is charitable donation. Starting 2026, IRS has made donation of up to 1,000 for single filers and up to 2,000 for joint filers above the line charitable donations, which means even if you take standard deduction, you can claim this as your deductible expenditure. The only condition is this has to be a cash donation and it has to be a public charitable donation.
So the example that we give, giving money to Panditji is not tax deductible. Giving money to the temple is tax deductible. It has to be a 501c3, not even C4 or C6, not Chamber of Commerce, not political organization. It has to be C3, a non-for-profit approved by IRS, listed on IRS website in order for it to qualify.
So on one hand, IRS is giving an opportunity, but on the other hand, it has taken up in a way that a floor limit for claiming charitable deduction while itemizing has been introduced. Floor limit of 0.5% of AGI is there if you want to claim charitable donation as itemized deduction starting 2026, which means that if you want to give any charities and claim it as donation, it has to be more than 0.5% of your income.
Again, going back to the bunching theory, if you are donating money, X amount of money every year, try to bring money from the next year to this year so you can claim the expenses. And next year you can claim the standard deduction. The charity is not allowed when you have the standard deduction.
There is a change in child tax credit. The limit has been revised up to 2,200 per child from 2,000 earlier. However, the remaining refundable portion has been kept the same as 1,700. And if you are having other dependents like elderly parents, there is also a credit available for them of 500.
So think about it. So there are two parts to it that I want you to understand. If you have no liability, no taxes, they don't give you 2,200. They only give you 1,700. That's the refundable portion. Second thing, the question we are asked, should we claim the parents on our taxes or not? And how much tax saving does it create to have our parents claimed on the tax return? For each person with a social security number, each parent, you save $500. The reason we discourage people, if you are claiming parents on your tax return, God forbid if they have to go to hospital sometime, just because they are dependent, the system will try to come behind you. If you don't claim them as dependent, I don't know who they are. This is your address. If you put in my address, does it make me responsible for your bill? Okay, the system doesn't have a way to come behind you for their bills, and just because with their age, the medical bills can be heavy. The point I'm trying to make, saving of $500 generally is not worth it. Even though we have saving $500, that's the legal rule. But practically speaking, a lot of time it doesn't make sense.
Next up is 529 education plan, because our kids need bright future. So for 529 education plan, there is a great change that Not only the spending limits have been increased up to 20,000 from 10,000, but the allowable expenditure are also enhanced. Like your kids' SAT school fees, their homeschooling fees is also included over here.
Earlier, 529 means money paid to an accredited university, accredited school. Now, my son is taking SAT classes, my son is taking this classes or that classes, home tutoring, therapies. I mean, it has been expanded to no limit, and the amount has been increased from 10,000 to 20,000. 529 doesn't really give you immediate deduction from your taxable income. It's not a tax deductible amount. That's why a lot of people were not using it earlier. Now they have increased the limits, increased the options where this money can be used. And if you don't use it for the child, just if you have two children, you invested money with each of them, you don't use it for one, you can move this money for the second one. Meaning is you're not limited to using this money for the person who you meant. You can give it to your neighbors. You spend the money for anybody.
So there is one more investment plan introduced called Trump accounts. For kids born between January 25 and December 28, IRS is giving a gift of 1,000 to them. Parents can invest up to 5,000. Even employers can invest up to 2,500 per annum in this plan. And this plan is a mix of 529 and Roth IRA. This money can be used for your kids' education, for their buying a new home, or for the retirement plan as well.
Absolutely. So the 5,000, and we said Roth IRA. So when you invest 5,000, it's not immediately tax deductible for you. But the growth is tax-free, like a Roth plan, like a Roth IRA.
So next up is estate planning. After all of these years, you built some wealth and you wanted to pass it on to your kids. So from starting 2026, the exemption limit has been increased up to 15 million from 13.99 million. Here are some strategies. You can try gifting appreciated assets instead of cash so that cost is counted in your limit, not the amount, and you have more cushion. If you plan early, consider estate planning even if you are below the federal exemption.
In New Jersey, there is no limit to it. And this 15 million is per person. So for husband, wife is 30 million. There is a form 706. This is a portability form, meaning one spouse happens to pass away earlier. Then you can do 706 filing to move the unused limit to the second spouse. So in theory, husband, wife has 30 million. But the question we are generally asked, do I need the estate planning? But let's say if you are 50 years old and you have only 5 million, you should still consider the estate planning, because by the time you move on to the next life, 20 years later, this 5 million will become 30 plus. Because every 7 years, you expect the money to double 10%.
A little relief for our senior citizens also there. Additional deduction of up to 6,000 for single filers and up to 12,000 for married couple can be claimed over and above the standard deduction. For this, of course, there is income threshold limit. If any senior citizens are getting closer to this limits, they can consider deferring their income in order to have this benefit.
So you just have to see how much income you are making, especially if you are in that bracket. Then look at it before the year end, see what you need to do to make sure your income doesn't close. So you have $6,000 of deduction, which can be something significant.
SALT deduction limit has been increased up to 40,000 till 2029. Of course, income limits are also there over here. 500 for married couple and 250 for single filers.
Yeah. So if you're making more than $500,000, then the limit goes down to 10,000. Right now, I mean, up until last year, the limit was 10,000. Now, temporarily, it's been increased to 40,000, but there are certain limits, income limits around it. If your income is over $500,000 married financial, then it goes back to $10,000 in the SALT deduction.
Next up is opportunity zones. If you are having heavy capital gains and you want them to be invested for a longer period of time, here's an opportunity for you. Investment in opportunity zones are still risky because they are not really developed areas. Government is trying to develop them. That's why they are promoting the investment over here.
So the idea here is if you invest money into opportunity zone, and it's misleading in the sense, if there were so many opportunities, why would the government have to give a special incentive to make people invest money in there? Government is giving a special tax benefit so people invest money into those areas because those areas are underdeveloped areas. That's why government had to come up with a special incentive. So the change here is, earlier the idea was you have to invest money for the longer duration. Now they have created a 10% increase in the basis after 5 years. Earlier the rule was you have to invest 10 years to avoid the capital. And this plan can only be used for capital gain, not for regular income. If you bought a business, sold the business, if you bought a home and you created large capital gain, you invest money into opportunity zone for 10 years, so you don't have to pay tax in the capital gain. Now what they did, they created limits, sub-limits, that if you have 5 years investment, we'll give you 10% of step-up basis. Meaning if you bought for 1 million, sold it for 3 million, we'll assume you bought it for 1.1 million. Or if it's a rural opportunity zone, we'll give you 30% step-up. So they have tried to make it better, but at the end of the day, the idea remains, it's not an opportunity zone. If it was really an opportunity zone, everybody would be investing in it. The government wouldn't have to give benefit to invest into it. What I'm saying is it's still a risky proposition.
So next up is a investment in startups is becoming more lucrative. Only the limit has been increased up to 15 million per issuer, but early withdrawals are also there. If you are withdrawing after 3 years, you pay capital gain tax of only 50% on your gain. And after 4 years, it is 75. If you hold for till 5 years, 100% of it is tax-free.
So this is created to incentivize a small business. But please remember, this business has to be a C corporation. LLC, S corp, they don't qualify for it. Can't be a pass-through entity. The money has to be invested, has to remain in there for at least 3 years. It used to be 5. This is the improved version, if you like. This is now the money can be taken out in 3 years. So let's say if you invested $100, now the company became public and company grew, and you keep the money for 5 years at least. So this is to encourage angel investing into companies like my friend is running here. But you have to keep the money and you have to make sure it doesn't run away.
That's up from individual side.